Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the previous episode, part 2 on position sizing, we covered how to use a backtest to understand which parameters actually matter when building a position sizing framework. We also looked at how to arrive at a leverage factor based on contract value. But when it comes to options, especially structured strategies like short straddles and short strangles, the rules change. Add to that periodic changes in the lot sizes, which directly impact position sizing, and the problem becomes even more nuanced. In this episode, we'll address options-related position sizing, especially in an Indian context. I'll show you how to think about position sizing and leverage for option strategies, using backtest data, notional exposure, and real-world constraints like cash, margin, and lot size changes. So without further ado, let's get started. Like I always do, let me start with the most important questions. As a trader, one of the first questions to answer is, how much capital do I want to allocate to trading as such? I'm not talking about particular strategies here. I'm talking about any kind of trading that you would want to engage in, be it in equity or commodities market. The reason this becomes important is because all your return, drawdown, and risk calculations must be based on this definition. This capital could be your entire investment portfolio, stocks, ETFs, mutual funds, pledged for margin, or only a portion of your investments that you consciously allocate for trading. It could also be just free cash. That's fine too. Whatever definition you choose, stay consistent to it. Do not call free cash capital one day and then net worth capital the next day. That inconsistency leads to confusion and bad risk decisions. Once you define your capital, everything else, returns, drawdown, leverage, and position sizing, starts making sense. What I've seen is the biggest mistakes traders make are not because of bad strategies, but because of poor position sizing and misuse of margin. Just because margin is available does not mean it should be put to use. Many traders pledge long-term investments and see large available margin and feel compelled to trade simply to utilize it. That urge to utilize full margin is what leads to unintentional over-leverage. Now back to the initial question. How much capital do you want to allocate to trading? Now, capital allocation should be based on two key factors. Strategy max drawdown, factoring in leverage. If you're trading multiple strategies, then each strategy needs its own separate allocation. And most importantly, the max drawdown value that you have factored in should let you sleep at night. For example, suppose you have 50 lakhs in investments across stocks, mutual funds, and ETFs, and you are trying to trade two strategies, one intraday and one positional. By pledging your investments, you get say 90% margin, which is 45 lakhs. But since you don't have any cash or cash equivalent margin, you can't trade positionally, that is, you cannot take overnight trades. You can only trade intraday, and even for intraday trading, you need some cash to settle mark-to-market losses. Hence, a more sensible approach to do this would be to calculate how much free cash you can bring in to trade and then reverse calculate the trading capital you can deploy. For example, let's assume you can bring in 5 lakhs free cash and you are willing to trade intraday strategies which have a historical max drawdown of 10% and not more, 10% on margin, not on spot. You should in reality assume that this 10% would turn into 20%, the 2x rule that is. Since you have just 5 lakhs in cash, you can only take positions utilizing up to a max of 25 lakhs of margin, including 5 lakhs in cash. Why? Because with 25 lakhs margin in use, even if you are into a 20% drawdown, your 5 lakhs free cash will be able to absorb it. That is 25 lakhs into 20%, and that's 5 lakhs. With this approach, you cannot do anything positional because your cash is already used for your intraday strategies. Now, if you want to trade a positional strategy on top of an intraday strategy, you would need to bring in more cash. And since for positional strategies you would need up to 50% of margin coming from cash, your per lot cash requirement goes up. In essence, position sizing for derivatives or F&O has to follow a reverse calculation approach based on the free cash you have, which would either be needed for mark-to-market losses or for the 50% rule in case of overnight positions. Now that we have a sense of how much capital to allocate to trading per se, let's move to the next and more important question. Many traders in India trade option strategies like short straddle and short strangle, especially on an intraday time frame, similar to what I shared in the 920 straddle video. But the more important question is, how do we position size for such structures? Now at this point, I want to call it out that you would need to have a basic understanding of how options work and also an understanding of option Greeks to make sense of what I'm going to share further. Okay, back to the steps. Now step 1, let's say you backtest an intraday short straddle strategy which has a 20% fixed stop loss on each of the legs on Nifty. Now the assumption here is that you tested this on real options data with accurate prices and lot size assumptions. So let's say the max drawdown per lot shows up as 20,000. So going by the 2x thumb rule, we will assume the real drawdown to be 40,000 rupees per lot. Now let's look at the margin required to sell an at the money short straddle. On an average, for 0DT option selling for Nifty, your margin required will be between 3 to 3.25 lakh. Now, if you want to do a bare minimum allocation, it will come to 40,000 plus 3.25 lakh, which is 3.65 lakh. If you ask me, that's still very aggressive. A more conservative method is to reverse calculate leverage from notional exposure and decide how much leverage you are comfortable taking. For example, maybe you're okay with a 4x leverage for intraday trading. Now the next question is how to calculate notional exposure for something like a short straddle. To figure the notional exposure for a short straddle, we need to apply this formula. Index or spot price multiplied by lot size into 0.5 delta. So that would be, let's say if Nifty is at 25,500, multiply that by 65 into 0.5 and that comes to 8.3 lakh. 0.5 because delta is at 0.5 as we are selling at the money call and put. Now we do a 2x of this 8.3 lakh value because we have two legs, a call and a put, and that would in total come to 16.6 lakh. Now, I'm sure the option geeks among us would say this is not accurate as delta would change and there will be gamma exposure. Yes, I completely understand that, but what I'm implying over here is this is a good delta-based notional value to be used as a rule of thumb, not as a worst-case risk value. So now we know that our notional exposure for a short at the money straddle is at 16.6 lakh. This value can now be used as a base to calculate leverage. Going back to the example of 3.65 lakh for a straddle at an exposure of 16.6 lakh, the leverage comes to approximately 4.5x. Now, if you want to play it conservatively and reduce the leverage to say 4x, then you should allocate 4.15 lakh for a straddle. This answers the question about how to position size for an option strategy based on its backtest and notional exposure, and it also helps us understand how to dial up or down leverage. The next issue to think about is lot size changes. Exchanges periodically revise lot sizes as the underlying price changes, and this directly impacts margin requirements. When you are position sizing, the logic should always start with the quantity. For example, if you are trading 15 lots with a lot size of 65, your total quantity is 975. Now there are two possible scenarios. If lot size increases to 75, you divide 975 by 75, which gives you 13 lots. That's the position size you would need to follow now. If the lot size reduces to 50, you divide 975 by 50, which gives you 19.5 lots. If you want to stay conservative, you would round this down to 19 lots, resulting in a traded quantity of 950. The idea is to always keep your per unit exposure constant. Lot sizes may change, but your risk shouldn't. There's one more thing I have observed some traders do. They buy cheap out of money options to reduce margin requirements. For example, let's say you're selling an at the money Nifty call and at the money Nifty put, and the call premium is priced at 100 and the put is at 110. As we saw earlier, you may need 3.25 lakh in margin for this. But if you buy an out of money call and out of money puts, say at 3 rupees each, your margin requirements may come down to 1.75 or 2 lakh per straddle. It's important to understand that by doing this, you are not hedging, you are only increasing your leverage. Your notional exposure still remains at 16.6 lakh, and by trading that exposure with just 2 lakh per straddle, you are essentially taking an 8x leverage. Both your gains and losses will work on a factor of 8. In short wall strategies which have limited gains and unlimited losses, such high leverage can be devastating. That said, professionals running multiple strategies may do this with portfolio level risk controls. Retail traders like you and me doing this to extract more juice from one strategy often ends up badly. We usually assume that tail risk exists only on the downside, but in reality, that's not the case. Think about what happened on 3rd Feb 2026. Nifty gapped up considerably and these so-called safe OTM positions blew up. One such day is enough to bring an end to your trading career. That logically brings in the question, how do you go about scaling up our allocation to a strategy or a basket of strategies? Scaling could either mean you are bringing in more fresh capital or your accumulated profits are big enough that you would want to use more of it. Either way, scaling up must respect position sizing rules. For example, if your position sizing calculation says one lot requires 5 lakhs, then 2 lots should require 10 lakhs. Now, how and from where you get those extra 5 lakhs doesn't really matter. At any point in time, you should not move to 2 lakhs with, say, just 7 lakhs with you. Just because you have accumulated profits of, say, 2 lakhs, it doesn't mean you can trade an extra lot. Scaling up early based on a few wins increases leverage. If a losing streak follows, profits will disappear much faster than you expect. Scaling slowly can seem boring, but that's what makes it sustainable, and that's how we need to go about it. Moving on to another but rarely discussed question is when to scale down. Now, it's possible that you're trading a strategy that has performed well historically, but right now it seems to have lost its edge or has gone into a deep drawdown. And this drawdown may be close to its historical max drawdown or more. Now, at this point, most traders simply stop trading the strategy because they feel the strategy is not working. And I'm not sure if that's the right thing to do. Now, talking about scaling down, when a strategy goes into a drawdown and sometimes it may even breach its historical max drawdown, I feel that's often the worst time to scale down. Sometimes it could be exactly the phase after which the strategy starts performing again. And if you scale down at that point, it may take much longer to recover from the drawdown. But scaling down is always way better than stopping it. What I have learned the hard way is it's always better to scale down than to stop trading a strategy, especially if it's in the nature of the strategy, for example trend following, to stay in drawdown for long periods. This is also where digging deeper into the strategy and its historical trade logs help. You are relatively less worried as you have seen the data. But if I see a strategy that can genuinely lose its edge over time, then I look to reduce allocation and shift that size to another strategy, either a new one or something else I'm already trading. That said, this approach has its own downside. Now, what if the strategy you reduced allocation to starts performing again? And the strategy you increase allocation to starts underperforming. Which is why, in my view, the most optimal solution is to use leverage so conservatively that you can withstand the drawdowns without being forced to make these hard allocation decisions at the worst possible time. But as I've said in the past, there are no perfect answers here. Now, if you notice, all that we have spoken about so far is about backtests and systematic strategies. But Some of you may ask, how do we size for discretionary trades? For discretionary traders, the only sustainable approach is to decide on a daily loss limit. Example, 0.5% of capital. Then decide on a per trade loss limit. Now reverse calculate position size. For example, say your capital is 50 lakhs. That gives you a daily loss limit of 25,000. That's the max that you can lose in a day. So in a way, you have decided a per trade risk of around 5,000. Let's say you're trading with Nifty, that means on a lot size of 65, you can afford to lose about 75 points per trade. So max you can size up to 5 lots. I have seen some traders use intraday profits as a buffer to size up later trades in the day. While not systematic, it's a reasonable risk framework. Now, talking about position sizing for discretionary trades, it's also possible to factor in volatility and size accordingly. In the podcast with Tom Bazzo, he mentioned that he sizes positions according to volatility. Now, what does that mean? To give you an example, suppose your stop loss is based on ATR or super trend and you have decided to risk, say, 1% per trade or 1% of your margin. Now, assume you trade 10 lots when volatility is normal and your stop loss is 100 points away, so your risk is at 65,000 rupees, and that represents 1% of your trading capital. When volatility rises and the stop loss widens, say 200 points, you automatically would need to reduce your position size to keep the risk per trade within your defined percentage of the total margin. That is, you keep your absolute loss constant at rupees 65,000 and now you trade 5 lots instead of 10 lots. The same applies on the other side. When volatility reduces and stop losses are smaller, say within 100 point range, you may trade more than 10 lots for the same percentage risk on your margin. I personally think this is a very smart way to trade, and many CTAs in the US use this approach for their position sizing. And that brings us to the end of this 3-part series on position sizing. Like everything else in trading, even in position sizing, there is no holy grail. If there's one key takeaway, it's this: the real edge lies in being conservative with leverage. That's what keeps you in the game long enough for your expectancy to actually play out. There's no fun in being right if you don't allow the math to work in your favor. As traders, we'll come across countless opportunities, and each one needs to be judged on its own merits. Over time, experience teaches us when to attack and when to defend. A bit like cricket. T20 cricket rewards aggression while test matches demand patience. And experience, like conviction, cannot be borrowed. Before I close, I have a book recommendation. In one of the older Zerodha AMA videos, I came across this book recommended by Nikhil. It's called Zurich Axioms, written by Max Gunther. He wrote it based on his father's advice on managing risk and reward. In the book, Max Gunther explains that successful speculators don't try to avoid risk, instead they try to avoid ruin. Think of leverage like crossing a fast river. No leverage means standing safely on the bank. By doing that, you never drown, but that way you also never cross. Too much leverage is like trying to sprint across the river in flood-like conditions. One slip and you are gone. Optimal leverage is about stepping in only when the water is below your knees, even if it means crossing slowly. Going by the book, the Zurich traders survived not because they predicted the river, but because they never entered when the current could knock them off their feet. Leverage works the same way. The right amount of leverage is not the maximum your margin allows. It's the maximum you can take and still stay standing when conditions suddenly change. If a single unexpected move can force position liquidation, margin calls, or emotional decisions, you are already violating the first rule in the book. Worry is a misuse of imagination. Proper leverage eliminates worry not by removing risk, but by ensuring that no single outcome can end your game. That is the real sweet spot. Not where the returns look best, but where survival is guaranteed long enough for your edge to play out. In Zurich terms, if you can't sleep with the position on, you are overlevered, no matter how good the strategy looks on the paper. I would suggest do read the book. You may find most of it online, and there's no risk in reading. That's something which I can guarantee. On that note, we come to the close of this 3-part series on position sizing. I hope you found these episodes useful and interesting. As always, do share your questions, thoughts, and feedback in the comments. I'll do my best to respond. Thank you for watching and see you in the next one.